Welcome, dear learners. I am Ankita Lakra from Department of Commerce. Welcome to this lecture series on financial systems. Today, we turn our attention to Unit 10, which focuses on the pillar of nation's economic framework, specialized financial institutions. Understanding specialized financial institution is essential because they operate at the very core of long-term economic development and structural transformation. While commercial banks primarily cater to short-term credit needs, working capital requirements, and routine financial transactions, the broader economy requires institutions that can provide long term finance, technical expertise, and developmental support. Large scale industrial projects, infrastructure development, and rural modernization, and small and medium enterprises growth demand patient capital and structured financial assistance. This crucial responsibility is undertaken by specialized financial institutions. Specialized financial institutions were established to address gaps in the financial system, particularly the lack of long-term industrial finance in developing economy. Their creation was driven by the need to accelerate industrialization, promote balanced regional development, and strengthen priority sectors. These institutions do not merely lend money, they also offer underwriting services, project appraisal, managerial guidance, and strategic financial restructuring support. In today's session, we will clearly examine the objectives, structure, and functioning of specialized financial institution. We will also study the significant contribution of key institutions such as Industrial Finance Corporation of India (IFCI), one of the earliest development finance institutions, and state financial corporations (SFCs), which play a crucial role in supporting small and medium enterprises in the state level. Let us begin by clearly mapping the journey we are about to undertake in this session. A well designed roadmap not merely brings clarity but also ensures that every concept fits meaningfully in the larger framework of financial system in a developing economy. By the end of this lecture, you will be able to accomplish four important learning objectives. First, you will develop a clear understanding of the fundamental concept of a specialized financial institution. We will explore why such institutions are created, how they differ from commercial banks, and what broad developmental objectives they serve, particularly in accelerating industrial growth, promoting balanced regional development, and supporting priority sectors in emerging economies. Second, we will study the classification of these institutions. You will learn to distinguish between national level institutions that operate across the country, state level institutions that cater to regional industrial needs, and investment institutions that mobilize and channel long term funds into productive sectors. Third, we will examine in detail the specific mandates, objectives, and functions of the Industrial Finance Corporation of India (IFCI). We will understand its historical background, its role in financing medium and large scale industries, and its contribution to industrial expansion. Finally, we will analyze the objectives and functions of state financial corporations which operate at the state level, focusing primarily on small and medium enterprises and promoting localized industrial development. By systematically covering these areas, you will gain a structured and comprehensive understanding of India's specialized financial architecture. Let us now examine the core concept in greater depth. Specialized financial institutions are distinct from ordinary commercial banks in both purpose and structure. while commercial banks primarily deal with deposits, saving accounts, and short term loans. Specialized financial institutions are established usually by the government with a clearly defined developmental mandate. Their main objective is not merely profit maximization, but the promotion of economic growth and structural development in key sectors of the economies. A crucial feature of specialized financial institution is their focus on medium and long-term financing. Commercial banks generally prefer short-term lending because it ensures liquidity and reduces risk exposure. Long-term projects, however, require funds to be locked in for extended periods, sometimes ranging from 5 to 20 years. Large industrial projects, infrastructure development, power plants, highways, ports, and heavy manufacturing units cannot be completed within short time frame. These projects demand patient capital and structured financial planning. This is precisely where specialized financial institutions play a vital role. Specialized financial institutions specializes in what is known as developmental finance. Developmental finance refers to the provision of funds for investments in fixed assets such as land, buildings, plant and machinery, technology upgrades, and large scale infrastructure. By financing such capital intensive projects, specialized financial institutions contribute directly to industrialization, employment generation, and regional development. Because of their long term developmental orientation, specialized financial institutions are often referred to as developmental banks or developmental financial institutions. Their role extends beyond lending. They may also provide technical guidance, underwriting services, and financial reconstructing support, thereby strengthening the overall industrial and economic framework of the nation. Now, let us reflect more deeply on this question. Why is government intervention necessary? Why can't the free market, driven by competition and profit motives, handle the financing needs of the economy on its own? In theory, free markets allocate resources efficiently. However, in practice, markets often fail to adequately support sectors that involves high risk, long gestation periods, and uncertain returns. Commercial banks and private investors typically prefer short to medium term lending where returns are quicker and risks are relatively predictable. Infrastructure projects, agricultural development, and small and medium enterprises, on the other hand, require substantial capital with repayment periods stretching over many years. The uncertainty of returns, exposure to external shocks, and lack of sufficient collateral make these sectors less attractive to conventional lenders. This is where specialized financial institutions play a transformative role. Their primary objective is to bridge the gap in long term financing that the private sector is often unwillingly or unable to fill. By providing patient capital, refinancing facilities, guarantees, and technical support, specialized financial institutions reduce the perceived risk associated with such investments. They enable the development of roads, power plants, irrigation systems, rural enterprises, and emerging industries, projects that are crucial for inclusive and sustainable national growth. Moreover, specialized financial institutions do more than supply funds. They nurture innovation, promote entrepreneurship, and stimulate balanced regional development. By supporting ventures, they may initially appear risky but hold long term socio-economic value. Specialized financial institutions act as catalysts for structural transformation and economic resilience. Specialized financial institutions provide long-term finance for sectors such as industry, infrastructure, agriculture, and exports. Since they lend substantial amounts for extended periods, maintaining a stable and diversified funding base is essential for their sustainability. Historically, the primary source of funds for specialized financial institutions was the government. They received capital through direct budgetary allocations and periodic financial support from the state. In many countries, central banks also contributed to their capital base, either by subscribing to their equity or by providing refinance facilities. Additionally, multilateral development institutions such as the World Bank, Asian Development Bank, and other international financial agencies extended lines of credit to specialized financial institutions to support developmental projects. These sources ensured that SFIs could provide long-term, low-cost finance aligned with national economic priorities. Over time, however, the funding landscape has evolved. With growing financial markets and increasing capital requirements, SFIs have diversified their sources of funds. They now actively access capital markets by issuing bonds, debentures, and other debt instruments. These securities are subscribed to by institutional investors such as insurance companies, pension funds, mutual funds, and banks, as well as retail investors. Such specialized financial institutions also raise funds through external commercial borrowings and international bond markets. By tapping into capital markets, specialized financial institutions reduce their dependence on government budgets and enhance economic autonomy. Diversified funding not only improves their credibility but also enable them to raise resources at competitive rates. This balanced approach ensured that specialized financial institutions can continue supporting long-term development objectives efficiently and sustainably. Let us briefly recap the key ideas from this introductory section. We have understood that specialized financial institutions are government-backed organizations created to meet the long-term financial needs of the economy. Unlike commercial banks, which primarily focus on short-term lending and working capital finance, specialized financial institutions are specifically designed to provide long-term capital for the creation of fixed assets such as plant, machinery, infrastructure, and large industrial projects. These institutions play a crucial developmental role by supporting high growth and priority sectors like infrastructure, small and medium enterprises, agriculture, exports, and housings, area that often involves high risk or longer gestation periods and may not attract sufficient funding from traditional banks. Specialized financial institutions also contribute to balanced regional development and industrial expansion. Their source of funds typically include government support, issuance of bonds and debentures, borrowings from financial markets, and assistance from multilateral institutions, ensuring a diversified and stable funding structure. Moving forward, let us examine in detail the specific objectives of specialized financial institutions. These objectives clearly reflect their developmental role in the economy. First and foremost is the provision of long-term finance. Unlike commercial banks, which primarily provide short-term and medium-term loans, specialized financial institutions are designed to finance projects that require substantial capital investment over a long period. Large industrial projects, infrastructure venture, and modernization programs often involves heavy initial costs and long gestation periods. Specialized financial institutions bridge these critical financial gapping. Second is sector specific funding. Specialized financial institutions do not lend indiscriminately. They focuses on priority and strategic sectors such as exports, agriculture, small and medium enterprises, renewable energy and housing. These sectors are vital for employment generation, foreign exchange earnings, and overall economic stability. By channeling funds into these areas, SFIs strengthen the backbone of the economy. Third, specialized financial institutions promote entrepreneurship development. They do not merely provide financial assistance but also extend technical guidance, project appraisal, feasibility studies, and managerial support. This integrated assistance encourages first generation entrepreneurs and reduces the risk of business failure. Fourth is balanced regional development. Private investment generally concentrate on metropolitan and developed region due to better infrastructure and profitability. Specialized financial institutions intentionally finance projects in backward and underdeveloped areas, helping reduce regional disparities and ensuring inclusive growth. Fifth is specialized financial institution facilitates infrastructure development. Critical sectors such as power, transportation, telecommunications, irrigation, and water supply requires massive investments. Specialized financial institutions play a vital role in mobilizing and channeling funds into these essential projects, thereby supporting long-term economic development. The objectives of specialized financial institutions extend beyond mere industrial financing and encompass broader socio-economic development goals. Sixth, export promotion plays a crucial role in strengthening a nation's balance of payments. Institutions such as export import banks provide export credit, refinancing facilities, and credit guarantees to exporters. By reducing financial risk and ensure timely availability of funds, they enhance the competitiveness of domestic industries in international markets and help boost foreign exchange earnings. Seventh, technological advancement is another key objective. Specialized financial institutions actively finance innovation projects, modernization programs, and research and development initiatives. They support the adoption of advanced machinery, digital transformation, and technology transfer agreements. This enables industries to improve productivity, maintain quality standards, and compete globally in a rapidly evolving technological environment. Eighth, employment generation is promoted by financing both large scale and labor intensive industries. When industries expand or new enterprises are established with institutional support, direct and indirect job opportunities are created. This strengthens economic stability and improves the standard of living. Ninth, these efforts contribute significantly to poverty alleviation. By generating employment and income opportunities, specialized financial institutions support inclusive growth and uplift economically weaker sections of the society. Financial assistance to small entrepreneurs and rural enterprises ensure wider participation in economic development. Finally, the ninth objective is financial inclusion. Specialized financial institutions strive to make financial services accessible to underserved populations, small businesses, and rural sectors. By expanding credit access and financial awareness, they ensure that the benefits of economic growth are distributed equitably across all sections of the society. Specialized financial institutions play a crucial systemic role in strengthening and stabilizing the financial architecture of a company. One of their key systemic functions is mobilization of resources. Specialized financial institutions mobilize funds from multiple sources, including the government, multilateral institutions, and capital markets. By pooling these resources, they channel long term finance into priority sectors such as infrastructure, agriculture, MSMEs, and industrial development, thereby supporting sustained economic growth. Another important function is diversification of risk. Specialized financial institutions lend across a wide spectrum of industries and sectors rather than concentrating on a single area. These diversified lending approach spreads financial risk across the system, reducing the likelihood of sector-specific shocks, destabilizing the economy. As a result, they enhance overall financial stability. Specialized financial institutions also contribute significantly to financial market development. When they issue bonds and other financial instruments, they help deepen capital markets. Their bond issuance provide investors with additional safe and long-term investment avenues, improve market liquidity, and encourage the development of a robust debt market. Additionally, specialized financial institutions act as effective tools for policy implementation. Governments often rely on these institutions to promote strategic sectors, regional development, or priority industries through targeted lending schemes, subsidies, and concessional finance. Specialized financial institutions translate policy objectives into practical outcomes. Finally, specialized financial institutions engage in capacity building. Beyond providing financial assistance, they offer technical support, advisory services, and training programs. This helps improve managerial efficiency, technological adoption, and workforce skills, ultimately strengthening institutional and industrial capabilities. To recap the objectives, specialized financial institutions perform a wide range of critical functions in an economy. They act as key financer of infrastructure and industrial development by providing long-term credit and financial assistance to sectors that require substantial capital investment, such as power, transport, manufacturing, and agriculture. Beyond financing, specialized financial institutions serve as instruments of social equity by promoting balanced regional development and supporting projects that generate employment opportunities, especially in backward and underdeveloped areas. By channeling funds into priority sectors, they help reduce regional disparities and foster inclusive growth. Additionally, specialized financial institutions contribute to the development of the financial market itself. They encourage the growth of capital markets, promote new financial instruments, and strengthen institutional frameworks. Through underwriting, refinancing, and advisory services, they enhance investor confidence and market stability. In essence, specialized financial institutions act as vital intermediaries through which government economic policies are implemented and transformed into tangible developmental outcomes. That's all for today. We will continue our session in our next video lecture. Till then, keep learning. Thank you.